Hello, and welcome to our video on inventories. Let's jump right in with an example. Let's say that we had a retail firm that purchased inventory worth of $100,000 from its suppliers, for which we paid $80,000 in cash and will still owe $20,000 to the supplier for. How would the accountant record this transaction? Well, the accountant would first start off with recording an increase in inventory under the assets for $100,000. Additionally, the accountant would record a decrease in cash of $80,000 for the amount that we paid at the time of purchase. Now you'll notice the balance sheet equation doesn't balance. We're left with $20,000 on the left side of the equation. Well, that's the liability that we owe, the part that we got for credit at the supplier. We call that an accounts payable. Notice there is no income statement impact. Revenues minus expenses has no effect here. There has been no change in wealth because what we've done is purchased inventory for part cash, part IOU, part credit. Continuing with this example, that IOU, let's say we've paid $10,000 of it off. So the accountant looks at the balance sheet equation and says we've reduced cash by $10,000, which will also reduce our liability of what we owe to the supplier of $10,000. Again, there is no income statement impact because what we've done is taken an asset and reduced the liability. No wealth has changed. The accounts payable account can be summarized as follows at the end of the year. The beginning balance will be zero. We added an inventory that we purchased on credit of $20,000. We paid part of that off during the year, cash paid to suppliers of $10,000, leaving us with a balance that we owe to the suppliers at the end of the year of $10,000. This was a simple example. We had only one supplier. You can think of a situation where a firm will have many suppliers, and similar to the accounts receivable video, we will have to keep track of each supplier individually. Also, let's continue with this example using a sales transaction. The firm sold products priced at $10,000 to a customer for cash. The purchase price or the cost of that product was $8,000. You may be asking, where did we get that $8,000 number from? That's a subject for another video. Let's go back and recall from the revenue recognition video that a sales transaction has two distinct parts. The first part is a revenue. Under the revenue part, this relates to an inflow of assets from which the customer has either paid us in cash or promises to pay us later. The expense part relates to the outflow of assets, generally the inventory. How would the accountant record the above transaction? Starting on the asset side, the accountant records $10,000 increase in cash from the cash that it collected from the customer and a $10,000 increase in retained earnings for the sale of revenue. Notice here that there is an income statement impact. There has been wealth that has been created from this sale, and the $10,000 in cash that we receive from the customers goes into the revenue. However, the second part is still not accounted for. So let's do it. We decrease inventory, what we sold to the customer of $8,000, which also reduced our equity, brought down our wealth of $8,000. Notice here that it's reflected as an expense and will decrease net income by $8,000. With these following transactions, how would the inventory account look? Well, we started with zero. We purchased $100,000. There was $8,000 in cost of goods sold, the amount that has gone out of the firm, the value of the inventory that is left. We have an ending balance of $92,000. The firm will present the information about inventories and accounts payable on its balance sheet as follows. Assets will record inventories of $92,000 and liabilities will have an accounts payable of $10,000. You may be saying, my balance sheet equation doesn't balance here. Note that there are other items on the balance sheet that we have not discussed, and that's the reason why. What we're trying to do here is take a snapshot of the balance sheet snapshot. The firm will present information relating to the sale of inventory in the income statement as follows. Revenues will be $10,000. That was the sale to the customer. And expenses will be cost of goods sold, $8,000 of inventory that we've given to the customer. That's it for our inventories video. Thank you very much.